Somewhere tonight, two people are opening their first investment account at the exact same time. Same age, same salary, same $400 left over after rent. One of them spends the next 6 months researching the perfect stock, watching crash predictions, waiting for the right moment to get in. The other one buys the most boring fund in existence, sets up an automatic transfer, and forgets the app is on his phone. 30 years later, the boring one retires with over $1 million. The smart one, the one who did all the homework, read all the news, timed all the dips, ends up with less than half of that. Same money, same market, same 30 years. It was not the investments that made the difference. It was the behavior around the investments. And in 2026 specifically, a year with a market that looks different from any year in recent memory, that behavior gap is going to be wider than ever before. This is exactly what I would do if I were starting from zero today. My name is Finn. I have spent years reading about money, how it works, why people make the choices they make, and what actually separates people who build wealth from people who do not. One book that changed how I think about starting to invest was The Psychology of Money. It taught me that getting started with imperfect information beats waiting for the perfect moment, because the perfect moment never comes. This is Finn Sharp. I explain money simply. Let us get into it. Most people do not fail at investing because they pick the wrong stocks. They fail before they ever buy anything. The most expensive financial decision most people make is not a bad investment. It is the decision to wait until they understand it better. It is a Sunday afternoon. You are sitting at your kitchen table with your laptop open. You typed "how to start investing" into the search bar 40 minutes ago. Since then, you have read about ETFs, index funds, brokerage accounts, expense ratios, and something called dollar cost averaging. Your coffee is cold. You have 17 tabs open. You have not done a single thing. You close the laptop and tell yourself you will come back when you understand it better. That moment, closing the laptop, costs more than almost any bad investment ever could. Here is what is actually happening. Your brain treats "I do not fully understand this" the same as "this is dangerous," so it tells you to wait, to learn more, to be sure. But investing does not reward the most informed person. It rewards the most patient one. Every month you wait is not a month of safety. It is a month of guaranteed loss, because inflation is running at 3.8% in 2026, and the average savings account pays 0.38%. Your money is losing value every single day it sits still. Not because you made a bad decision, because you never made one. Here is what 10 years of waiting costs in real numbers. You are 25 years old. You wait until 35 to start investing $300 a month at 7% average annual return. Starting at 25, $300 x 12 months, x 40 years grows to approximately $790,000. Starting at 35, $300 x 12 months, x 30 years grows to approximately $378,000. The difference, $412,000. From the exact same $300 per month. That $412,000 was not lost to bad investments or market crashes. It was lost to 10 years of "I will start when I understand it better." The most expensive class you never attended is the one you kept postponing. Postponing feels safer right now for a very specific reason. And that reason is real, not imaginary. Here is the uncomfortable truth nobody in finance wants to say out loud. You have chosen one of the strangest years in modern market history to start investing. Knowing that does not mean you wait. It means you invest differently. It is a Wednesday morning. You are reading the financial news with your first coffee. The headline says the stock market just had 3 incredible years in a row. Returns of roughly 25%, then 18%, then another 11%. You think, perfect. I finally want to get in. But somewhere underneath that excitement is a quiet worry. What if I am getting in at the top? That worry is not irrational. This time, it is actually backed by data. Here is what the numbers say about 2026. The S&P 500, the index of America's 500 biggest companies, is currently trading at its second highest valuation in 140 years of recorded market history. There is a measurement that compares stock prices to actual company profits over a decade. The long-term average of that number is around 17. Right now it sits at approximately 38. The only time it was higher was December 1999. You know what happened right after December 1999? On top of that, 7 companies, the biggest names in American tech, now make up roughly 35% of the entire S&P 500. When you buy the market in 2026, you are making a massive concentrated bet on a handful of technology companies. Vanguard, one of the most trusted investment firms in the world and the least dramatic institution in finance, is currently projecting U.S. stocks will return 3.5% to 5.5% per year over the next decade, not the historical 10% average, because when you buy something expensive, future returns tend to be lower, not because the market is broken, because math works the same way it always has. Here is what this means in real numbers for your 2026 portfolio. $500 per month at the historical 10% average over 30 years approximately $1,130,000. $500 per month at a conservative 5.5% for 10 years, then 7.5% after approximately $590,000. The difference between optimistic and realistic expectations, $540,000. Knowing this upfront protects you from quitting when the returns feel slow in year 3. Expensive markets do not mean you wait. They mean you invest smarter, not harder. Smarter means building what goes underneath the investment before you buy a single share. Here is the paradox almost every beginner misses. The thing that destroys most first-time investors is not a market crash. It is a $900 car repair. It is a Friday afternoon. You just made your first real investment, $1,500, money you saved for 4 months. It felt good. Then, 3 weeks later, your car needs a repair. The bill is $900. You look at your bank account, almost empty. You look at your investment account. The market dipped this week. Your $1,500 is now showing $1,320. You feel sick. You sell everything to cover the repair. You lock in a real loss. You tell yourself investing is not for you. That sequence happens to thousands of first-time investors every single year. And the investment was fine. The foundation underneath it was missing. Before you invest a single dollar in the market, 2 things must happen first. First, destroy high-interest debt. If you are carrying a credit card balance at 22% interest, paying it off is mathematically identical to finding an investment that guarantees you a 22% return. There is no fund, no stock, no strategy that reliably beats that. Every dollar of debt above roughly 7% interest gets eliminated before serious investing begins. Second, build a starter emergency fund. 3 to 6 months of basic expenses sitting in a high-yield savings account. Not your regular bank account paying 0.38%. A high-yield account, which in 2026 pays around 3.5% to 4%. Same protection. 12 times the interest. This fund is not savings. It is armor for your portfolio. It is what allows you to look at a crashing market and feel nothing, because your rent is already covered. Not because the emergency fund earns great returns, because without it, every market dip becomes a forced sale. Here is what a missing foundation costs long-term. You invest $1,500, then sell at a $200 loss due to an emergency. You stay out for 8 months, feeling discouraged. $1,500 left invested for 25 years at 7% approximately $8,100. $1,500 sold and reinvested 8 months late approximately $7,600. The $900 emergency that had no buffer cost $500 in future wealth, plus 8 months of compounding that never happened. The foundation is not the boring part you do before investing. The foundation is the investment. Foundation is built. Now, the most important decision most people never make: which account to use before you choose what to buy. Here is the part that confuses almost every beginner, and it is not their fault. An account is not an investment. A 401k is not something you buy. It is a container, a bucket with specific tax rules, and the actual investments go inside the bucket. The bucket you choose decides how much the government takes when you are done. It is a Tuesday evening. You open a brokerage app to start investing. The first screen asks you to choose an account type. You see individual brokerage, Roth IRA, traditional IRA, rollover IRA. You stare at these options for 4 minutes. You close the app. That 4-minute stare is where most people stop. Here is the order that makes it simple. Step 1. Your 401k, but only up to the employer match. If your employer matches 50 cents for every dollar you put in, that is an instant guaranteed 50% return before the market does anything. About 1 in 4 workers never captures this. Collectively, Americans leave around $24 billion of this free money unclaimed every single year. Log into your 401k portal this week and make sure you are contributing at least enough to get the full match. Step 2. A Roth IRA. You open this yourself, online, at any major brokerage. Takes about 10 minutes. In 2026, you can contribute up to $7,500 per year if you earn under $150,000. The deal is simple. You pay tax on the money now, it grows for decades, and every penny, including all the growth, comes out completely tax-free in retirement. For someone early in their career, in their lowest tax bracket, this is one of the most valuable trades available to any ordinary person. Step 3. Back to the 401k, contributing beyond the match toward the annual limit. Step 4. A regular taxable brokerage account for anything beyond that. Not because the order is complicated, because the wrong order costs you tens of thousands in unnecessary taxes over a lifetime. Here is what using the wrong account costs in real numbers. Same $500 per month invested for 30 years at 7% return. In a taxable account, gains taxed at 15% annually equal approximately $520,000 after tax. In a Roth IRA, zero tax on growth equal approximately $606,000 after tax. The difference, $86,000 from the exact same money and the exact same investments. The account is not paperwork. The account is one of the highest paid decisions you will ever make. The account is open. Now the question everyone came here for, what do you actually buy? Here is the answer that Wall Street has spent decades trying to hide behind complexity. You buy the whole market. You pay almost nothing in fees. You do almost nothing after that. It is a Saturday morning. You finally have your Roth IRA open. You are looking at the list of funds available. There are hundreds of options. Some have exciting names. Some have managers with photographs. One fund at the top of the list has a name so boring it sounds like a mistake. Total Stock Market Index Fund. Expense ratio, 0.03%. You scroll past it looking for something that sounds smarter. That scroll is where most investors quietly make their most expensive mistake. Here is the real data on picking individual stocks and paying professional managers. A study analyzed every U.S. stock since 1926, the entire history of the modern market. 4 out of every 7 stocks returned less over their lifetime than a basic government savings bond. The majority of stocks ever traded were not worth buying. All of the market's wealth came from a tiny fraction, roughly the top 4% of companies. The problem is that nobody knows in advance which 4% those will be. Not you. Not the professionals. A research scorecard that tracks professional fund managers every year found that in 2025, 79% of professional U.S. stock pickers failed to beat the simple market index. Over any 20-year period, about 92% of them lose. These are people paid full-time, with research teams, with decades of experience, and 9 out of 10 of them lose to a list. The solution is to stop trying to find the needles and buy the entire haystack instead. A total market index fund gives you a tiny piece of every major company at once. You will never beat the market, and you will never lose to it. You will get the market's return, which beats roughly 9 out of 10 professionals over your investing lifetime, given the 2026 market specifically. U.S. stocks expensive, international stocks relatively cheaper. A simple starting portfolio looks like this. 60% U.S. total market index fund, VTI, expense ratio 0.03%. 30% international index fund, VXUS, expense ratio 0.05%, 10% bond index fund, BND for stability. Total annual cost, approximately 0.03% to 0.05%. Or, and this is the option I would genuinely recommend to anyone who wants to think about this for 0 additional minutes, one single target date index fund with your retirement year in the name. It holds everything above, rebalances itself automatically, and costs about 0.08% per year. One fund, one decision. Done. Not because simplicity is a compromise, because simplicity is the actual strategy that wins. Here is the fee math that should make complexity permanently unappealing. $100,000 invested for 30 years at 7% return. At 0.03% annual fee, grows to approximately $761,000. At 1.00% annual fee, grows to approximately $574,000. The difference, $187,000. consumed by a fee. Not a crash, not a bad pick, a fee. The most boring fund in the room is usually the most powerful one in the portfolio. The most boring fund cannot protect you from the hardest part of investing, which is the moment everything inside you screams to sell. Here is the most important thing I can tell you about 2026 specifically. Given the valuations we looked at earlier, a significant market correction is not a risk. It is a scheduled event with an unknown date. It is a Tuesday morning, 18 months from now. You wake up and check your phone. The market is down 28%. Your investment account, which had $14,000 in it yesterday, now shows $10,000. The news is full of words like crash and panic. Your stomach drops. You open the app. You stare at the red number. Your thumb moves toward the sell button. That thumb movement is where most investing stories end permanently. Here's the data on what that decision actually costs. A research firm tracked what the stock market returned versus what the average investor actually earned. In a year when the market returned 25%, the average investor earned only 16.5%. That gap, 8.5 percentage points, did not come from fees or fraud. It came from behavior. People sold after things went down. They bought back in after things went up. They paid the most expensive price the market charges, the price of emotion. There is a study that looked at what happens if you invest $10,000 and stay fully invested for 20 years versus missing just the 10 best single days in that entire period, fully invested. Your return is about 10.6% per year. Miss the 10 best days out of roughly 5,000 trading days. Your return collapses to 6.4%. Here is the part that matters most. 7 of the 10 best market days happened within 15 days of the 10 worst market days. The rebounds happen right next to the crashes. The people who sold during the panic missed the recovery that happened the following week. Not because the market is cruel, because the market transfers money from the impatient to the patient every single time. Here is the protocol. Decide this now while you are calm, because you cannot decide it clearly when the crash comes. When the market drops, you change nothing. The automatic transfer keeps running. Every paycheck buys shares at a lower price. You do not check the app daily. You do not watch people explain why this time is different. You remember that over every single 20-year period in American market history, including the Great Depression and 2008 and COVID, the market has never lost money for the person who stayed. $10,000 invested. Market drops 30%. You sell. You have $7,000 and a locked-in permanent loss. $10,000 invested. Market drops 30%. You do nothing. 18 months later, you have approximately $11,000. Write this down somewhere. You will see it when the crash comes. When it drops, I do nothing on purpose. That sentence, followed through, will be worth more than every other financial decision you ever make combined. The person who opened their laptop on that Sunday afternoon, the one with 17 tabs open and cold coffee, started 3 weeks after watching a video like this one. Not because everything became clear, because they understood that starting unclear beats staying comfortable. They did not open a complex trading account. They opened a Roth IRA on their phone in 9 minutes, put $200 into a target date index fund, and set up an automatic transfer for the first of every month. Then they closed the app. 6 months later, the market dipped. Their account was down $140. They felt something uncomfortable. They remembered the protocol. They did nothing. The month after that, their automatic transfer bought more shares at the lower price. A year later, the account was up. Not because they were clever, because they were still there. The person who researched for 6 months and waited for the perfect moment, still waiting, still watching, still promising themselves they will start soon. Here is the big truth. Investing in 2026 is not complicated. The market is expensive, yes. Returns may be slower for a while, yes. But the alternative, inflation at 3.8%, quietly destroying cash that earns 0.38%, is a guaranteed loss with zero chance of recovery. The plan is simple. Kill the high-interest debt. Build the starter emergency fund. Capture the full employer match. Open the Roth IRA. Buy the total market index fund. Automate the transfer. Do almost nothing after that. None of this requires genius. All of it requires just enough patience to let time do what it has always done. If this changed how you see getting started, there is more where this came from. FinSharp exists to explain money in a way that actually makes sense. Subscribe so you do not miss what comes next. And remember, the goal is not to find the right moment to invest. The goal is to stay invested long enough that the right moment finds you.